And I think you have to kind of take a step back and see what the biggest players in the world are doing. And the biggest players are the central banks who are massively de-dollarizing and buying commodities. And I think that's kind of the thrust that fits hand in glove with Zoltan Pozsar said. We are heading into a new era based on commodities and transparency, not opaque debt instruments and promises that seem to fall short. And I just think that this is something that will be a very, very...
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it. Imagine a world where gold, traditionally a symbol of stability and wealth preservation, defies all odds and embarks on a historic journey towards an incredible $5,000 mark. It's not just a dream, it's a possibility that's unfolding right before our eyes. Today, we're diving into this fascinating story, exploring the intricate web of geopolitical tensions, economic shifts, and market dynamics that are setting the stage for gold's potential monumental rise. Gold has always been a haven in times of uncertainty, and the current geopolitical landscape is no exception. The rising tensions in the Red Sea region have sparked a surge in risk-averse trading, pushing investors towards the safety of gold. But this is just the tip of the iceberg. The undercurrents of this rally are much deeper, tied to complex global dynamics that could propel gold to heights previously deemed unreachable. Now let's talk economics. The recent U.S. Producer Price Index data fell short of expectations, fueling speculation of an imminent dovish shift in Federal Reserve policy. This is crucial because when the Fed eases its policies, it often leads to a weaker dollar, making gold more attractive as a hedge against currency devaluation. But there's more at play here. The decline in U.S. Treasury yields, particularly the short end of the curve, is also bolstering gold's appeal. As yields drop, the opportunity cost of holding non-yielding assets like gold diminishes, making it an even more enticing investment. And let's not forget the dollar's performance. Despite a mixed showing, the overall trend suggests that changes in the greenback's strength play a significant role in gold's trajectory. As the dollar fluctuates, gold often moves inversely, adding another layer to this complex financial puzzle. So as we stand at the cusp of what could be a golden era for gold, the questions abound. How will these geopolitical tensions continue to influence the market? Will the Fed's policy decisions light the fuse for gold's rocket to $5,000? And how will the interplay of yields and dollar strength shape this journey? Stay tuned as we delve deeper into these questions, unraveling the intricacies of the gold market. And remember, hit that subscribe button to not miss out on any updates on this potentially historic financial voyage. As we delve deeper into gold's potential ascent to an incredible $5,000, it's vital to dissect the recent inflation reports and their implications on the Federal Reserve's monetary policy. This aspect is a crucial piece of the puzzle in understanding gold's trajectory. The latest inflation data, specifically the Producer Price Index, PPI, has come in below expectations. This isn't just a minor statistic, it's a significant indicator that could sway the Fed's approach towards monetary policy. Typically, lower than expected inflation rates might prompt the Fed to adopt a more dovish stance, potentially leading to lower interest rates. So, why does this matter for gold? Gold often thrives in low interest rate environments. When interest rates are reduced, the opportunity cost of holding non-yielding assets like gold decreases, making gold more attractive to investors. Additionally, dovish policies usually lead to a weaker dollar, further enhancing gold's appeal as it becomes cheaper for holders of other currencies. But there's a twist. Just a day before the PPI data, consumer inflation figures came in higher than expected. This conflicting data creates a complex narrative for the Fed and the markets. While the PPI points towards a dovish policy, consumer inflation data might suggest caution. It's a delicate balance, and the Fed's interpretation of this data will be critical. Interestingly, some Fed officials have already commented on the December data, seemingly pushing back against expectations for a rate cut in March. This adds an element of uncertainty to the mix. Market participants will be keenly observing the Fed's next moves, as any indication of a policy shift could significantly impact gold's price. As we navigate these economic undercurrents, one thing becomes clear. The path to $5,000 for gold is not just about market trends and investor sentiment. It's deeply intertwined with macroeconomic policies and data interpretation. In our next segment, we'll explore how the U.S. Treasury yields and the dollar's performance are influencing gold's journey. Make sure you're subscribed to catch every twist and turn in this captivating financial story. As we continue our exploration into gold's potential surge towards $5,000, it's crucial to understand the role of U.S. Treasury yields and the dollar's performance in this financial drama. These elements are not just background players. They are pivotal in shaping gold's upward momentum. Let's start with the U.S. Treasury yields. Recently, there has been a notable decline in these yields, especially at the short end of the curve. This decline is significant because it reduces the attractiveness of holding government debt compared to non-yielding assets like gold. When Treasury yields fall, gold often becomes a more appealing option for investors seeking safe haven assets. But the story doesn't end there. The yield curve, specifically the 2-10s inversion, is also a critical factor. This inversion, where short-term yields are higher than long-term ones, is often seen as a sign of economic uncertainty and can lead investors to flock towards safer assets like gold. The recent plunge of the 2-year Treasury note, which has narrowed the yield curve inversion, adds to the allure of gold as a reliable store of value in uncertain times. Now let's turn our attention to the dollar. The US dollar index, DXY, a measure of the dollar's strength against a basket of major currencies, has shown mixed performance. However, even small fluctuations in the dollar can have a significant impact on gold prices. A weaker dollar makes gold cheaper for investors holding other currencies, potentially increasing demand for the yellow metal. But it's not just about the current state of the dollar or the yields. It's about the trends and expectations. If market participants anticipate further weakening of the dollar or a continued decline in Treasury yields, we could see a sustained increase in gold buying. In our next segment, we'll delve into the technical outlook for gold, examining key levels and indicators that could signal whether gold's path to $5,000 is not just a possibility but an impending reality. Don't forget to subscribe to stay updated with our comprehensive analysis and uncover every key factor driving gold's journey. As we venture further into our analysis of gold's potential leap to $5,000, it's time to examine the technical outlook of the gold market. This perspective will provide us with crucial insights into the possible trajectories and key levels that could either pave the way or pose hurdles to gold's unprecedented journey. Currently, gold's daily chart exhibits a strong upward bias, indicating a robust bullish sentiment in the market. This bullishness is underpinned by gold's recent rally, bouncing off the weekly lows of $2,013 and surging towards the $2,060 area. Such movements are not just random fluctuations. They are indicative of a market that is gathering momentum, poised for further climbs. However, in the world of technical analysis, nothing is absolute. The key lies in observing and interpreting potential resistance and support levels. The immediate level that gold buyers are eyeing is around the $2,050 mark. This level is crucial. A decisive break above it could open the door to retesting weekly highs and potentially reaching further milestones like $2,100. On the flip side, failure to reclaim and hold above the $2,050 level could lead to a temporary setback. The first support level in such a scenario would be today's low of $2,028, followed by the week's low of $2,013. These levels are critical as they could either reinforce the bullish trend or signal a need for revaluation. It's essential to note that the journey of gold to $5,000 will not be a straight line. Markets are dynamic and price movements are influenced by a myriad of factors, both technical and fundamental. Each resistance breached and support held fortifies the path towards $5,000, but each failed attempt demands a reanalysis of the market conditions. In our next segment, the apex of our analysis, we will synthesize all the information we gathered, the geopolitical tensions, the economic data, the movements in Treasury yields, and the dollar, along with this technical outlook, to paint a comprehensive picture of how gold could realistically reach the once unthinkable price of $5,000. Make sure you're subscribed to get the full story and our exciting conclusion. We've now reached the apex of our exploration into gold's potential ascent to $5,000, a juncture where all the strands of our analysis converge to form a comprehensive narrative. In this culmination, we'll integrate the geopolitical factors, economic data, movements in Treasury yields, and the dollar, and our technical outlook to understand how this extraordinary price target for gold could be achieved. First, let's consider the geopolitical landscape. The tensions in the Red Sea region have sparked a risk-off sentiment among investors, driving them towards safe haven assets like gold. This shift in investor sentiment is a powerful force, capable of propelling gold prices upward as global uncertainties fuel demand for stability and security.
Confidence in the rest of the world has in us. And so what I'm getting at is that when you see China and Japan and Saudi Arabia and Russia and all of these countries shed U.S. treasuries, what are they doing with their excess reserves? They're buying gold. And that's why you see over the last 2 years, the central banks buying more gold than any time in human history. And if we look at the performance over the last 2 years, what did I say it was? It was 1801 average price in 2022, 1943 in 2023. You go back over the beginning of the century, a 7.8% annual return not only beats the S&P, but destroys the bond market. So maybe they're taking a step back and saying, maybe we just load up on gold because that pretty well acts just like a bond. In fact, it's outperformed it. It has greater or lesser volatility right now, and we don't have to rely upon the honesty and the transparency of the West. In fact, there's no counterparty risk. We can hold it ourselves. And so when you realize this transformation of attitude and of reality, where gold is holding its own, but I think it's actually catching the attention of a lot of nations around the world who are shedding U.S. treasuries and in favor of gold, as crazy as that sounds. But what did the BIS call it? Oh, yeah, the only other tier one asset in the world alongside U.S. dollars and U.S. treasuries. So if you want to break reliance on the Western system and on the Western hegemony, well, certainly pricing goods in other currencies for settlement chips away at the settlement of the U.S. dollar. And what did we see last year? 2023, over 20% of all oil sales in other currencies, right? They're chipping away. All of these deals we see settling in other currencies, chipping away. And how about the reserve status? Well, you keep beating up and chipping away at the settlement status, it's going to have effect on the reserve status. But I do honestly believe that a lot of these governments view gold, by looking at its performance over the last 20 plus years, as maybe even a better alternative to treasuries. Now, the one thing they don't have would be that immediate liquidity, but they do. I mean, you have to move it from storage, and that's always why these countries have kept gold at the Bank of England and the New York Fed, because they're the trading humps where they can just move it from one vault or one pile to another and then get paid. But I do think that there is a shift, a gradual shift that most of the dollar bulls don't notice yet. And, I think the dollar milkshake theory has been spot on. I think he's a smart dude, Brent Johnson. I think he's been right. But I think little by little by little by little, logarithmic decay, again, that's my favorite term, and so many things I look at around the world, is chipping away not only at the settlement status, but this move to gold, which has held its own against the S&P and bettered supposedly the most liquid, stable market in the world that now has actually less volatility than the 10-year Treasury, I think is beginning to take on a different view or a different image with the rest of the world. So I think what that question is something people really need to think about. You do not need to issue a currency with a reserve standard in order to greatly affect the reserve standard of the U.S. dollar. You can issue or trade in local currencies. And especially when you look at all of the countries joining the BRICS, another 30, according to Putin, have formally applied. I thought it was 20. He says 30, and up to another 20 informally. This massive swath of humanity joining this group and settling right now. Remember, that was the deal. We're going to task the finance ministers to go back to the drawing board, come back to the meeting in October in Russia. There's over 200 meetings in Russia this year, all about BRICS. But the big one is in October, where they're going to come back and present their findings. But in the meantime, they're all trading in each other's currencies with one another. Sure, the dollar is still the world reserve. Sure, the dollar is still the emperor who maybe has no clothes. But the point of it is that you are beginning to see the chipping away of the settlement status of the dollar in favor of local currencies. And ultimately, the BRICS could issue not only a common settlement currency or just a decree that if you want to trade with the BRICS nations, it has to either be in gold or in local currencies until we issue a common settlement currency. And maybe someday they issue a reserve currency or a bond market to challenge the West. But in the meantime, I think, and if you look at the numbers, they really don't lie, that gold could indeed represent that hole that would be in place if they shift away from taking the reserves or the excess. That was part of the petro deal. Will you value oil in dollars and take the excess and put it in treasuries? Well, if you remove the treasury aspect and put it into the other tier one asset, gold, with no counterparty liability and breaking free from the Western hegemony as they all want to do, to me, I think that's on the table. That's a playbook that I think you'll see more and more of here in 2024.
Turning to the economic front, the recent PPI data falling short of expectations suggests a potential dovish shift in Federal Reserve policy. Lower interest rates resulting from such a policy shift would decrease the opportunity cost of holding non-yielding assets like gold, making it an increasingly attractive investment. Furthermore, dovish policies typically lead to a weaker dollar, enhancing gold's appeal as it becomes more affordable for investors using other currencies. The dynamics of the U.S. Treasury yields also play a crucial role. The decline in yields, particularly at the short end of the curve, decreases the attractiveness of holding government debt, steering investors towards gold. The yield curve's behavior, particularly the inversion scenario, is a critical indicator of economic uncertainty and has historically been a catalyst for increased gold investments. From a technical standpoint, gold's price movement shows a strong upward bias. The breach of key resistance levels like the $2,050 mark and the ability to maintain above these levels could signal a continued bullish trend, paving the way for further climbs towards $5,000. Integrating all these factors, it's evident that a combination of heightened geopolitical risks, dovish monetary policies, shifts in Treasury yields, dollar dynamics, and a strong technical outlook creates a fertile ground for gold's potential surge to $5,000. It's a journey that encapsulates the complexities of the global financial landscape and the timeless allure of gold as an investment. Remember, while this analysis paints a plausible scenario for gold reaching $5,000, it's crucial for investors to remain informed and adapt to changing market conditions. This isn't financial advice, but an exploration of possibilities in a dynamic and ever-evolving market. Thank you for joining us on this in-depth analysis. If you found this journey insightful and wish to stay updated with more such comprehensive financial explorations, don't forget to subscribe. Stay tuned as we continue to delve into the fascinating world of finance, where possibilities are as vast as the markets themselves.